stocks, which, given Wednesday's historic move, are on pace to end higher this week. We will debate the markets with the investment committee. Joining me for the hour today, Steve Weiss, Jim Leventhal, Brenda Vingello, Kevin Simpson. We'll check the markets. I'm almost hesitant to tell you what we're doing at the very moment because it's been that volatile again. What is green now could be red in 30 seconds, but that's the kind of session and that's the kind of world we're living in right now. Rather than sort of go through all of the stuff that you and everybody else already knows, bond yields are elevated, the dollar, et cetera, et cetera. We're going to get to some of that. I like to think on this show, you guys, all of you, are charged with trying to give investors ideas on what to do in volatile times like these, in a volatile market like this. Whether you're supposed to, as some say, buy the dip. Many people come on the network and say, if you're a long-term investor, buy this dip. Others say, volatile environment's going to remain, sell the rips, move into other asset classes, which has been harder because there's been almost no place to hide in any of this. Traditional things where some of our viewers like munis, obviously bonds, the dollar, even gold at times has not been the kind of safe haven play that some people view it to be. All that is a lead up to you, Kevin, because you have been buying many blue chip names in this weakness. Looking at some of the best companies in the world, blue chip stocks that you believe are maybe somewhat of ports in this crazy market storm.
Well, with the exception of McDonald's, each one of those names was down 30% in about a month. So even more than the broader markets. Now, can they go down further? Absolutely. We don't call bottoms. I'm not here to predict anything that's going to happen over the short term. But a 30% drawdown on Meta, 30% drawdown on Caterpillar. What we're seeing with McDonald's, a little bit different story, but maybe a trade down for the consumer. Caterpillar obviously is going to be subject to global issues, and I think we can get to Apple separately.
Let's get to Apple now. I mean, because that's one of the most hotly debated stocks within this market. It's down 26% off of its 52-week high. And let me set the stage as well, because literally right when I sat down on this desk moments before our program, our senior producer sent me a note that Jim Cramer has just put out that says, quote, I'm wavering on, quote unquote, own, don't trade Apple, that it's now harder to defend Apple stock in the trade war. That's significant coming from somebody like Jim, who has made the case for literally as long as I can remember, and I have these words in my head. Own, don't trade Apple, because he says it so often. But this is different. The game's different. The goalposts have moved. Should your thinking move like Jim's?
I think it's not going to change or move like Jim's, but it's nice to see that there's some more opportunities to trade it. In the past 13 years, I've sold out of Apple in its entirety 11 times. I trade Apple. I don't own Apple. Most recently in December, we sold it at 247.5. Coming in back on Tuesday at 177. That's attractive for us. On Wednesday on the pop, I wrote a 215 call. Short's going to expire the first week of May. Brought in $1.30 on it. We trade Apple like crazy, and I think Jim's point is completely spot on. This game has changed. What's happening with tariffs could be devastating, and I'll give you a worst case scenario because we modeled it. What if Apple earns $5 a share? Because that's a real possibility. And what if you bring the multiple down to 25? $125 stock for Apple. We're paying $177 for it. It's probably trading in the 190s right now. We're not buying the whole position. We'll buy it on the way down. But just recognizing that it could go lower, you have to be careful in these markets, and you can't get too tricky.
If we had room at the desk, I would say, Jim Cramer, come down here right now and talk about this. And if he wants to stand at the end of the desk and have a conversation with us, he's still more than welcome to show up at our table. And I'll leave that to him. You bought more Apple today?
Yeah, actually yesterday, but it doesn't matter. It's in the context of this. Most great long-term investors will tell you that most of the time you're trying to buy great companies at okay prices, good prices. And that is, that's a Warren Buffettism, that's a Howard Marksism, and I think it's a Kevin Simpsonism, and probably Brenda and myself as well. But you now have this opportunity to buy great companies, and I submit to you that Apple is still great at very good prices. I'm not going to say great prices, it's still mid-20s. I get it. But this is an opportunity in the downturn that we've seen to upgrade your portfolio because everything's got smeistered here. So why not trade out of some of the more speculative things into the companies that are likely to thrive on the other side of any downturn that happens? And we can discuss whether Apple will thrive on the other side of this, given that it's in the crosshairs of the China trade war. My opinion is, yes, it will. I don't know how the trade war is going to end, and like Kevin, I'm not calling a bottom either. This thing could obviously go lower. But I look at the prices compared to where they were just 4 or 5 months ago for one of the best companies in the world, and I am absolutely buying. It's not the only thing I'm buying, by the way, because a lot of times when we talk about great prices or great companies, we talk about tech. I've been buying Citigroup, as you know, Scott. Also bought Wabtec today, great industrial in my opinion. Bought some AstraZeneca, and I think this is interesting because pharmaceutical tariffs are on the come. There is still some bad news to come, and yet I look at companies like AstraZeneca or AbbVie or Vertex, and I say, wait a second, these are companies that are doing great things, and they've been repriced for maybe not all, but a lot of the danger in the market right now.
Not the more recently cautious person on this program. I'm wondering how you're now viewing. The market's down a lot. We had, a couple of really rough days. We had a historic day, and then we had another rollover yesterday. None of it in normal-sized moves that you generally see. What's your take, man? You've been through a lot of markets like this.
So on Wednesday, as bearish and as concerned as I am, not about just the near term, but the longer term, as we cede our spot, and I firmly believe this, as the preferred trading partner, the preferred capital partner to Europe and to China. As a matter of fact, they're getting together to hash out policy. I did say on Wednesday that the pain trade and the most likely move will be higher, and that was the case Wednesday afternoon. A much quicker time frame than I envisioned. Only get back about half those gains on Thursday yesterday. So the way I look at it is that that's still the case. As a matter of fact, if Trump does, as he said at his cabinet meeting, he said he can settle all trade issues with all 70 countries in one day. If he goes out and does that in one day, then the market's off to the race.
Don't you think, as we said yesterday, don't you think, I mean, I've been talking to a lot of people, you know, a lot of people on the floor here, and I think to a person, everybody says the risk is to the upside.
Yeah,
now, because all it takes is a thing for the White House that says the president and President-in-Chief scheduled a call, or top representatives are going to speak.
And I believe
you think this market's going to be red?
And no, and I'm not saying
no,
that.
I know. I'm saying like a rhetorical question.
I agree with you, and I agree with them. And look, this is going to be, over the next 90 days, a series of small wins that are headline wins but have no substance. Because as you know, it takes years to negotiate a trading agreement, and it takes months to even put together a term sheet. For acquisitions that we make of substantially less value, those term sheets can take 6 months to do. But it's going to trade on the headlines, and it's because there are lots of people sitting in a lot of cash, lots of people that are positioned adversely to a market run that's going to work. But here's what I'd say. I'd say that earnings will also be the test. Now, we've been fortunate. We've had bank earnings, which have been good. And, you know, as you would expect, the Jamie Dimons of the world, they look at it, they can see the downside, but neither are they doomsayers. So they're not there to rattle investors or rattle the market. They're there to give just really a perfectly spoken word and comment about, here are the risks we see, but here's what we've done, and we are well positioned to handle any adverse environment. Sure. So I do think that the pain trade still is to the upside, particularly on the weekend when there's no news coming out. I won't go into the reason for it.
Right.
Simply no
Even so, you know, there are plenty who are suggesting that, you know, the game has changed, that a lot of damage has been done, and even if there is a positive development, that you've left a lot of rubble in your wake here.
I'm still reverting closer to the 25-year average multiple, which is 16 times, which could put you below 4,500.
I wanted you to listen to what Larry Fink said on the network earlier. He says he thinks we're still, you know, we're already in a recession.
Yep.
He did talk about rates too, which I thought was interesting, but he made a comment about the larger ramifications of what's happened because of the policy from the White House and what the bigger picture looks like around trade and tariffs. We have that, guys?
The United States, post-World War II, was a global stabilizer. We are the global destabilizer. And that's a very, you know, that's a very hard thing to say.
I thought the commentary was interesting. I thought the way that he said it, how he paused for a moment to acknowledge that it's a difficult statement to make, but certain ways that things in the market are trading, dollar, bonds, etc., may represent that perspective, which you also heard from Mohamed El-Arian on social media today, that the moves that you see there could represent an erosion of confidence in the U.S. Bank of America's Flow Show, you know what the title was today from Michael Hartnett and the crew over there? U.S. exceptionalism ending, U.S. repudiation starting, that you essentially have a buyer's strike of U.S. assets.
I don't see who the points are well made, and damage has been done, both to the economy and to the United States standing in the global economy. The problem that I see on the other side of that is I don't see any other leader emerging. Maybe they will, but I don't see it now. And I want to embrace the fact that damage has been done to the economy, unquestionably. But there's another side to this. The context in which we're operating was an economy that was very strong as we went into this, whatever you want to call it. And it's not just that GDP was growing, it's that profit margins were high. It gives companies some cushion before they lay people off. Now, that won't last forever, and we've got to stop this, and we've got to get back on a forward footing in terms of growing the economy. But the banking system has been strong. You haven't seen somebody blow up and get taken out. You know, there's all this worry about the Treasury spiking and whether some hedge fund was going to blow up. You know, the Fed thinks that it's still restrictive, which means that they want to cut. They're getting a little bit of leeway on that with the inflation numbers. My point on this is to acknowledge damage has been done economically and to the United States standing. However, it's not a fait accompli yet, keyword yet, that this is irretrievably lost.
No, but there is a perspective too, guys, that like Larry Fink also said in this chair earlier, that he can easily see a 5% 10-year because of embedded inflation from the trade war. And he made the point that a week ago today, he was shocked, he said, by the move lower last Thursday and Friday in the 10-year. We're all reacting to the rate of change and the level we are now relative to last Friday. It's not the absolute level of where we are today that's unnerving. It's the rate of change from just a week ago, in which he said he was shocked at that, not this, that this feels more normal. If we're in a more normal, higher inflation environment, then all of you have to think about the other kinds of moves that you might make in this market, no?
100%, because tariffs are inflationary, whether that's transitory or not. The 10-year was at 3.9. Last Friday, 3.9.
That's what he's saying. He was shocked at that.
The move is incredible.
Just look at the dollar, 3%. Like, it's unbelievable. So the problems exist, and to Jim's point.
Which is there is evidence, Jim, in terms of rates, in terms of the dollar, that the U.S. is not the default economy. We're seeing it.
Who's taking over, Steve?
Oh, I think there are plenty to take over. I think that, well, China has been very patient in terms of what they've done. They've moved in areas that we've ignored, such as Africa and South America. They are now doing that in terms of meeting with Europe, and they will forge those relations because there's no secret where China stands. You know what they are, you know what they do. There's a lot of secret in terms of where the U.S. stands now, because Trump doesn't know where he stands. That tariff plan was finalized right before he went to talk about it.
I know, but so, I don't want to. I just don't want to relitigate it.
No, I'm not relitigating. My point is that there's no stability, so there's no dependency in terms of who you're trading partner is, whereas China, believe it or not, you give that to them.
I disagree that China's going to take over U.S. leadership.
I'm not saying they are. I'm saying there's enough.
Sounded like you just said that.
You want to let me finish, or you want to?
No, you already said it.
I'm saying that they are in a better position right now.
I asked you who's going to take over leadership. You said China. Don't backtrack it 30 seconds later. I will tell you I disagree with that assessment. If you meant to say something else, then correct it now.
I'm going to say what I said before, which is that they are in a better position to do it now than the U.S. I didn't say they're taking it over. I said they're in a better position.
You told me that the United States has ceded its leadership. I asked you who was
it has ceded its leadership.
Then who's taking it over?
Nobody's taken it over yet.
Okay.
Good. Then we agree on that. Well, yeah, we agree in a moment in time. You continue to look backwards. I'll continue to look forward.
You continue to look forward by making conjecture. You have no idea. Nor do I.
Of course, it's conjecture.
But I'm willing to take the risk. You say that you know. And I would submit to you that the right words are, you believe this is going to happen. You certainly don't know because nobody knows. And I will tell you, in a condition where nobody knows, I will fall back on historical patterns, which is U.S. leadership, even as it's been damaged, leadership economically particularly. And if you want to change that, someday it will change. I don't think it's now.
If you're done preaching, let me just make sure to say, Jim, let me talk.
I have to appeal to the judge. Am I preaching or is he preaching?
Jim, let me finish, okay?
You talk forever. Just say it succinctly.
Just finish quickly because I want to get something else.
I'm taking half the show. Look, the U.S. has ceded it, okay? It's ceded leadership. Nobody's picked the crown up yet. Things don't happen in a day. But there's not a country out there that trusts us as a trading partner versus before Trump, they did. So it's that destabilization that are going to force them to find other partners. That's just natural. So we'll see that, and those will continue to impact our capital markets, will continue to impact our dollar, will continue to impact rates as they have been. That's just what's happening.
I understand that there's a lot of emotion on all sides of this. It's been a tumultuous week. Investors are unnerved. That's part of the fallout from all of this that is going to reverberate for a while. People are emotional. I have another move from you which felt emotional, to me anyway, but you can explain it better than me since it's your move. You sold small caps, a case that you have consistently made on this program to own for months, okay? You sold it on Tuesday, if not at the low, darn close to it. Why?
Well, it's a minor detail, but I sold it Tuesday in the morning when the market was rallying. But to the point, and I made this earlier, of why I sold it, it's an upgrade to the portfolio. I have plenty of stocks in the portfolio that are, I don't want to use the word speculative, but do require the economy to come through this okay. And you know what they are, Scott. I mean, I can list them if it's a Delta, if it's a Win. You know there's
I know, but you sold this down a lot.
Okay, because everything's down a lot. I mean, everything's down a lot.
But you just made the case that you still think this is the place to be and invest.
And that's why I am fully invested overall.
And you also said you don't see a recession.
That's okay, and that's why I'm not selling Delta, and that's why I'm not selling Win Resorts, and that's why I stepped into Citigroup. I mean, this is not something where I'm going to all utilities and staples. I mean, in my portfolio, I'm underweight utilities and staples.
David Kostin today says maybe you should. Stay defensive.
I mean, that's the argument that Steve and I, at least in part, are having about where the economy goes from here. But let me be clear. With everything being sold off, this is an opportunity, as I said earlier, to buy great companies at what I think are very good prices. So make no mistake, I am clearly looking for the economy, even if it goes through a recession, to be a short recession and one that we recover on the other side. If this is going to be something like the great financial crisis or COVID, then you certainly don't own Delta going into that. But this is not some chicken little move. It's not, okay? I've got plenty of high beta in this portfolio.
I didn't say it.
I'm paraphrasing.
Small caps lead you out. So I wonder why, if your view is so opposite of what's happening in the market, you would sell the asset class that is going to do best in recovery.
Because I haven't sold the asset class. I mean, look at things like Casey's.
You just said you sold.
Calm down, Steve. Casey's. I mean, what have you bought?
If you keep coming at me like that, you know it's not going to help you. So stick to the facts.
All right, you're way too sensitive. Okay, and I understand it's an emotional time.
You're too worked up.
No, look at the things that I own. Look at a Casey's. Look at a Vertex. I mean, as I already said, look at a Delta. Look at a Win Resort. I don't. If I've taken a little bit out of small cap, I'm not out of small caps entirely. Not at all.
So that line's wrong. You didn't sell small caps.
Steve, what I sold was the ETF, which was one position out of 25 in the portfolio. It was approximately a 4% position in my portfolio.
How big is your largest position?
I've taken that 4% and I've recycled it into Apple, into Wabtec, which is a mid-cap stock. I mean, it's going to perform pretty much similarly the way. Okay, but you know, in the same ballpark, AstraZeneca.
Just for context, what's your typical large position?
It depends. If it's something,
just average large position. I'll make it easy.
So I have a 25 to 30 stock portfolio, which means on average things are going to be 3 to 4%. They will be bigger in the case of an Apple, where you look at the benchmark and it's roughly 6.5%. I'm now at 6%.
You asked the question, and after this, we are going to take a break. What are you buying? You did buy more Goldman Sachs on when it was red. Today?
Yeah, I did buy when it was red today.
This morning?
Yes,
okay.
This morning.
Tell our viewers.
I was encouraged, first of all, by the earnings from JP Morgan. And as I've said repeatedly, David Solomon, to me, is one of the best CEOs in not only corporate America, but around the world. And guess what? They've also navigated similarly tough times. And what happens in these, haven't been on that side of the fence, not being in David's position, of course, what you do is you go out and you talk to your accounts and you hold their hands to this and you advise them. But the job's actually easy from that standpoint because they reach out to the most knowledgeable, reliable partners. So I can tell you that Goldman's phone is likely ringing off the hook and that they will really strengthen the bonds that they have as well as pick up new relationships. So again, I like it. It's very high quality. It was already a core position. I just took the opportunity, knowing full well with my view that this could go lower.
The executive producer just got a phone call here ring. I was wondering if that's like cleanup on aisle 4 after you guys. We'll take a break. We'll get out the bounty and the band-aids and whatever. We'll come back after this. We're going to talk about our calls of the day. We're also going to be joined in a little bit by legendary energy trader Mark Fisher because he is laying out what he thinks could be the best risk-reward trade right now in the commodity space. All right, welcome back. One key question through all of this uncertainty and volatility is how the retail investor is faring. Kate Rooney is following that money for us and joins us now with what you found.
So, Scott, individual investors, as we're seeing, have been leaning right into that volatility you've been talking about and continue to buy the dip. The buying remains what Vanda Research calls robust, even after retail investor activity broke records last week. As JP Morgan put it this week in a note, investors have been willing to place confidence on the market upside despite radical policy uncertainty. That did pay off, at least on Wednesday, with some of the tariff and market relief. Also, the post by President Trump that, quote, this is a great time to buy. At the close of that day, the average retail portfolio was up 17%. That was according to JP Morgan as well, although markets did then reverse. On Wednesday at the close, we did see some retail investors start to sell single stocks and then lock in some of those gains. The dip buying really started to move more to ETFs at that point, which Vanda Research says suggests some longer-term broad bets on equities. Vanguard's S&P ETF is among the top trades. That's one signal of that. And the flows, if you look at single stocks, it's still really only NVIDIA, mostly NVIDIA at least, consistently the most actively traded name. If you look at sort of the top names, to put it in context, we had one day this week where there were $3.5 billion that went into single stocks for a day. $3 billion of that went into NVIDIA alone. Other retail favorites like Tesla have seen a little bit more of a mixed sentiment. There's been a little bit of hedging with some of the tech inverse ETFs, the SQQQ, and then the YOLO crowd, as we talked about yesterday, Scott, is alive and well. Risky leverage Tesla ETF is popping up as one of the top picks, and then one with double exposure to the Nasdaq 100. Those are still among the most actively traded names, at least on Fidelity today. Back to you.
All right, Kate, thank you very much for that rundown. Appreciate that. Come back, lots of attention on the commodities markets this week with crude oil hitting a 4-year low on fears of dropping demand. Meantime, gold surging to a new high lately as investors look for somewhere to hide in all of this market turbulence. For more on where the best risk reward is right now in the commodities complex, Mark Fisher's going to tell us. He is the CEO of MBF Trading. What a time to talk to you. I can't even imagine how your trading desks must be at the moment. Give us a sense.
It's been, to put it lightly, Scott, pretty chaotic, but organized chaos is the best way I like to describe it.
I mean, moves that you would normally expect to happen in 3 weeks or 3 months are happening sometimes in like 3 minutes.
Even less than 3 minutes, but yeah exactly.
So give me your view. Let's just start with oil. I teased this out as, you wanted to give our viewers what you think right now is the best risk reward in the commodity space. And it's not oil, but just give me your view on where you think actually crude is going, because it's at a 4-year low, as we said.
Well, there's really nobody left long. Everyone's worried about a recession. The wild card is obviously Iran and what happens with these talks between the United States and Iran. Because obviously all bets would be off if you go ahead and get some kind of a nuclear strike there. But currently, with demand forecasts being what they're being, with the market, oil's not really exciting to me, other than the fact that all bets are off if something happens, when Strait of Hormuz, if something happens in the Middle East that no one can really predict. But it's in the papers now more and more every single day.
What do you think's next? $50 or $70, for example, for WTI?
70. And the reason I say that is because everyone's short. The sentiment index out there is, I don't know anyone that's long. So, if everyone's short, who's left to sell? I mean, you have all the Mexican hedges that have been put on already by all the producer countries that drove the price down. You have all the fears of the economy imploding. So to me, that's just purely a sentiment call, nothing else.
But I get, but that's sometimes how you have to trade things. So many different factors go into crude, for example. So you yourself, you're long crude, thinking it's going to that.
But we're long out of the money calls, but we really have. Obviously, we trade every day, but we don't really have a strong conviction right now in energy, in crude oil, just because of there's too many. That's not the best place to put your wagers at right now for us.
Yeah, I hear you. One of the best places you do think is ags, grains, right?
Yes.
Which we hardly ever talk about. But why now?
Well, that's probably one of the reasons why it's going to go up, right? It's because no one talks about it, right? If you think about it, right, all the commodity indexes, first of all, increased the weighted allocation to grains at the beginning of the year. So now you've got all this passive money that, no matter what happens to the price of grains, can't get out. Secondly, after last year, when you had oversupply of crops, you had grain prices, corn, wheat, soybean, collapsed 20, 25, 30%. This year, it's a whole different dynamic in terms of the strength of the cash markets and funds. And more importantly, think about the tariffs, the trade wars. If I'm going to go ahead and have to import from the United States, what's the easiest thing to import? Right? Consumable food, right? Corn, wheat, soybeans, right? I don't need to go ahead and build out infrastructure for that. I can import that stuff, hopefully use it against, my commitment to the United States, right? And everyone needs food. And unlike OPEC, where, you can say drill, baby, drill, there's no such thing in farming as,
grow, baby, grow.
Grow, baby, grow. It doesn't work like that, right? So on top of that, you add all the dynamics of, what's going to happen this summer in terms of the crops. I mean, to me, that's the most exciting and probably the best opportunities. The risk reward is definitely 3 to 1, 4 to 1. Could it work? I hope it does, but again, if someone gives you an investment where it's 1 down, 4 up, with a probability, probability ratio, you have to make that bet in the markets every day.
Does it matter which wheat, corn? I mean, you look at that granularly?
I talk to people. Some people like soybean meal oil. To me, it's just easy to trade. Corn, because it's for me it's just the most liquid and I know it the best. But again, corn's following the grains. I think are going to end up following the same dynamic of gold. What's happening now is that in gold, if the market goes down to gold $100, no one's getting out, right? All the central banks are not getting out. No one cares. And the fact that now you have this passive long money that's just buy and hold, which is what the stock market used to be, it's now because of all the anxiety two-way market. I think this buy and hold mentality, if it takes place in the grains, should really make these markets move pretty significantly.
Are you in part saying that you think that it's a plausible scenario in the trade war with China, for example, that part of making incremental deals towards, maybe a larger, more significant outcome is striking a deal where China, for example, would agree to buy more of our grain and more of our ag products, and then that would be certainly a stimulant for a trade to work like this, not to mention with inflation expectations moving where they are.
And with the dollar being, with the dollar-based currency, just the dollar being there. But I don't know if it's China so much as other countries, because we've had that deal with China in the past, and to some degree they reneged on their commitment. But I look at the EU, if you look at, Italy, if you look at other countries, Vietnam, it's an easy way for them to go ahead and match what they need to do in terms of the import-export formula without having to go even to China. I mean, obviously China is the largest consumer, but that breadbasket mentality can be done by any of the foreign nations.
Let me just end, since you mentioned gold. Obviously, people have been watching it run up. I think 3,200 is where it is now. We can pull it up now. It's obviously been at record highs. There were a couple moments this week where it didn't work either, but certainly has. There's no question about that. Where's that? I mean, are there shorts there? I mean, where's that going?
Well, to me, think about what's happened. This is a marketplace that's now a buy and hold mentality. If anyone's invested in gold, if it goes down $100 from here, they're not getting out. So if you have these permanent longs in the market, like we used to have in the stock market, and people get short, if the market rallies, which I think it will, and if you're short, who does the short get out to if the longs aren't going to ring the register, right? Typically as the market goes up, shorts cover and longs will liquidate. If the longs aren't getting out and the shorts want to liquidate, the only person the short can get out to is a new short, and the only way you get a new short in the market is by driving the price even higher. So, I'm probably saying the top right now in gold short term. So as we're talking, I'm saying, okay, this will be the short term top for the next week because that's just the way things happen. In the long run, the anxiety barometer, the VIX of the world is gold, right? And so for that purpose alone, and for the fact that the ETFs are less committed to gold than they were before, right? We had a bigger open interest in the ETF in GLD 3 years ago than we have now. There's no reason why gold can't keep going up. It's up 30% this year. Why can't it be up 50%? So who knows? How high is high? I have no idea. Like the panelists, I think, said how low is low. They don't know. The gold is how high is high. They don't know. But the mentality has changed. Where gold is now becoming an asset that if it's down $100, people aren't panicking. People are going to hold it, and because of that, that philosophy changes the way people trade.
I can't thank you enough. Really great insight for our viewers on a topic, frankly, that we just don't get to all that often on this program. Mark, thanks so much. Mark Fisher is the CEO of MBF. I should let you know, too, that I'm going to go to Eamon Javers here at the White House with a news alert. Market is, I think, around the highs of the session here. Eamon, something you have from the White House telling us maybe why?
Yes, Scott, I don't know if this is moving markets or not, but we just heard from the President of the United States on his social media platform saying that he has forced 5 of the nation's top law firms to offer up more than $500 million worth of law services to causes that he supports. Those firms, according to his social media post just now, are Kirkland & Ellis, Allen, Overy, Shearman, Sterling, Simpson, Thatcher & Bartlett, Latham & Watkins, and then also separately in a separate settlement announced in a different post, Cadwalader, Wickersham, and Taft. All of those firms, the President says, have agreed to post at least $500 million in pro bono and other free legal services during the Trump administration and beyond to support causes that the Trump administration and the firms agree to both support, including things like veteran services and others. And also these firms have agreed to abandon their DEI programs, which the Trump administration calls discrimination. Some of these firms have been sent letters from the EEOC, Scott, suggesting that they were discriminating in their hiring practices, and some firms have seen executive orders targeting them for those practices. This is an effort by those firms to get ahead of it. And Scott, it amounts to sort of a semi-nationalization of big law here in terms of taking over enormous amounts of legal talent and deploying it in a way that the president wants for his political reasons. And he's doing it because these are firms that have hired or worked with his political enemies.
Yeah, Eamon, thanks for that update. Eamon Javers at the White House. I don't think that's why the market's moving, but nonetheless, it is moving.
If he can take those services and expand his ability to negotiate tariffs with other countries, because these are great negotiators, then that could be one reason. It's
well, now you're really
shaky.
You're really getting
shaky,
out there.
but it goes to what we said before. Any headline will get the market going.
I know. Well, that's the risk in everything.
Yeah.
As why we're on headline alert. So when we see the market moving and you're told Eamon Javers has news, you're like, oh, okay, what could this be? All right, more earnings next week, which is why we have the setup. Brenda, we go to you first for J&J. Talk about some healthcare name.
Yeah, so I think so far this earnings season, we've only heard from financials, so we haven't heard about what the real impact from tariffs could be on businesses, just on the broader economy. But I do think with the J&J, that is going to be what everyone's going to be focusing on, and unfortunately there's not a lot of clarity there. But I think if we take off the tariff uncertainty, the underlying trends for the company should still be fairly decent, looking for around 5% earnings or revenue growth. But I think it's going to be very muddied up by tariff comments and uncertainty.
Kev, UNH?
Yeah, the cornerstone.
Next Thursday morning.
Who wants to wait that long? Wish we didn't have this weekend coming up.
All right, game it out for people then.
UNH is going to have great numbers. It's going to be fantastic. It's the cornerstone of the healthcare space. We trimmed it a little bit with the DOJ news. Glad we didn't sell it out. It's been one of our best performers. The problem with all these earnings, though, next week, it's backward looking and it doesn't affect anything having to do with tariffs. To Brenda's point, we'll listen for guidance, we won't get it. So this might be like the best earnings season we ever have that nobody cares about.
The most interesting about UNH, of course, is that right now it appears they're targeting Medicaid cuts, which could impact the business. But with Medicare Advantage, they have a way to negotiate around it.
It's funny, Netflix is trading like a staple, like a staple. like a real port. Like people are like, oh, I'm never getting rid of my Netflix. I don't care what happens with the tariffs and the economy. It reports next week, real quick.
Yeah, I think it's going to be a great quarter. I mean, you never know on the subscription, but overall, this is one you hold.
All right, we'll do finals next. So join me closing bell today for the final stretch of a crazy week. Tom Lee is going to be with us. So is the tech investor Glenn Kacher, and I hope you'll join me then. Let's do some final trades. Kevin Simpson, you're first.
TJ Maxx, it's a standout name in a tough retail environment. Solid earnings, free cash flow, great balance sheet.
Bren, safe travels back west. Nice having you here.
Thank you. Happy to be here. So Meta, I think it's going to be a winner in the overall advertising space.
All right.
AbbVie.
Taiwan Semi, exempted from China chips. I think it'll do the same thing in the U.S.
All right, good stuff. I'll see you on the bell.
Hello, everybody. Welcome to Blue Cloud Trading. My name is George. It is Friday, April 11th. It's 4:49 p.m. as I'm recording this. It's after the close. We can see how the market performed. It was mostly up, as you can see. We're going to take a look at this heat map in a few moments. We're going to look at how the markets were up. We're going to take a look at the sector performance in this video. And we'll also go over many of the stocks that they talked about in the show. All right, so we're going to take a look at some of those. We'll look at the Fab 7 stocks, and we'll look at the indices. And I'll be posting a second video a little later today with Tom Lee, and where I'll go over the sectors, the member requests, and country ETFs in that video. So stay tuned for that. It's coming out soon. And let's first take a look at the news for today. So Dow jumped 600 points on Friday, capping one of the most volatile weeks on Wall Street ever. And so that is some good positive news right there. Let's take a look at this. Now, here's some negative, unfortunately. Mortgage rates surged over 7% as the tariffs hit the bond markets. So the average rate now in the popular 30-year fixed mortgage surged basis points on Friday was 7.1%. And mortgage rates are now the highest level since February. Okay, this person here says, forget about housing in this environment, says Nancy Lazar, Global Chief Economist at Piper Sandler. And then there was one other headline here. Highest tariff since the 1930s to trigger recession. S&P 500 declined to 4,200, 4,500, says BCA Research. It's just one of the research firms out there. All right, well, let's take a look at the Dow. It was up 1.56%. Nasdaq was up 2.06%. S&P 500 up 1.81%. And the Russell 2000 was up 1.46%. And another note here, I just want to show something. Currently, at least for today, 73% of the stocks were advancing, but it's approximately just 21% of stocks that are experiencing new highs versus new lows, which is 78.8. And you can see that here. The stocks that are above the 50-day moving average it's just 12% of stocks. 88% are still under the 50-day moving average. And then as far as the 200-day moving average, it looks like 17% are above the 200-day and about 83% below. So interesting information there. Let's look at the heat map actually first. You can see all the S&P 500 stocks, how they performed. Meta was down though, 0.5, and so was Netflix slightly. Disney was down just 0.4%. Texas Instruments down 5.75, but Nvidia was up, Amazon, Apple, Google, and it looks like pretty much most stocks were up. This is the one-day performance. Let's look at the 1 week performance. At the end of the week here, you can see that healthcare was down the most. They got hit a little bit. The healthcare plans like UNH were up 14.17%. They talked about that on the show. Some of the oil and gas like Exxon and CVX were down. Consumer defenses were up. Walmart's up 11.55%, and Costco's up 5.12% for the week. So interesting. And then here's a 1 month performance. Let's see how the stocks are doing for the month. Well, it looks, in this scenario, it looks like Walmart, Costco, UNH up 24.5. You can see some of the banks like JP Morgan and Visa, but Berkshire is also up 3.94%. But you can see Meta's down, Google, Amazon, Apple, Nvidia. A lot of the semiconductors are still down for the month. This is what the percentages, if you want to take a look at that. Basic materials was up the most, up 3.64%. And communication services was down the most, or up the least, actually. It was only up 1.16%. Here's the 1 week performance. Energy, real estate got hit the most this week. And the 1 month performance, energy and healthcare, real estate were down the most. And consumer defensives were up. And there's the 3 month. Okay, let's get into these stocks now. We're going to take a look at the Dow Jones first, DIA ETF, and we're going to start off with a weekly chart. Since it is the end of the week, we can now have some clear